Okay, so let's talk about the chapter from where we left off. Okay, in the class. Let- so we were talking about the manufacturing overhead budget in the class. I just want to quickly show you because and remember this area of the budget is just to make sure so you understand this, so I always ask you a multiple choice questions regarding what is going on in this in this side of the budgets. Most likely quantitative question may not be. I'm not so much interested in quantitative, but I am interested in asking you logical questions, conceptual questions in this area. So for manufacturing overhead budget is divided between variable costs and fixed costs. And variable costs, these numbers are given to you normally. For example, in the first one, it says indirect materials, it's $1 per hour. What hour? It's direct labor hour. And if you look under the bottom of this table, like right above the bottom, it says direct labor hours. This number is just taken from the direct labor budget. You remember we made that budget in the class last time. So these numbers are just from there plugged in here. And now we are just multiplying. For example, here it's $1 per direct labor hour. So $1 multiplied by 6,200 is equal to $6,200. So it's just a calculation, and then fixed costs. We're supposed to give you the numbers. So I'm not that much interested, but just to show you that this variable manufacturing overhead budget, the ideas are all coming from our first two chapters. That was what are the manufacturing costs? It is direct labor costs. That's why we did direct labor budget. We had a material budget, so that's why we have a material budget that we produced in the class last time. And now we have an overhead budget. So three kinds of costs make up the manufacturing cost. And that's what we are doing here. So, as a result of this budget, now we have a total manufacturing cost for the whole year next year, right? That number, if you divide that by the total number of labor hours, is going to give you the overhead rate. And so, if you remember, that was chapter number 2 and 3, where we learned that we always estimate annual overhead. And that's what we have done here. For the next year, we have estimated what the total overhead will be, which is 246,400. We divided by the direct labor hour because that's what this company thinks is the closest way to allocate manufacturing overhead to the units this company produces. So that rate is $8 per direct labor hour. So depending on how much usage of the direct labor hour is, we will allocate that. Okay, so these are previous concepts. This is an illustration. I'm not going through the illustration, so you can do that if you want, just for your interest. But I'm interested, first of all, in this question. A sales budget is what? Derived from production budget, management's best estimate of sales revenue for the year, not the starting point for the master budget, prepared only for credit sales. Of course, it is answer number B. If you remember, I extensively discussed that when I was working in the bank, it took us almost 4 months just to determine the interest rate for next year, because interest rate matter for the bank's loans, right, for the future, how many loans the bank will sell. So this is all based on there's so much analysis goes into sales forecast, and then the rest of the budget is determined based on that. So now, as a result, I'm going to quickly summarize. You've done the sales budget, you've done production budget, you've done direct materials budget, you have done direct labor budget, you've done overhead budget. And now right away your logics should tell you that we are going to form an income statement, which is budgeted income statement as a result. And wow, the great thing is that for the whole next year, we will have a good idea of what the profit is going to look like once we will have this budgeted income statement. So this is a basis of evaluation, evaluation for the company's performance for next year, right? So now we have an idea of about the future. Management has already thought what they're gonna do about the future. Isn't this great? This whole budgeting process. So before we get into the budgeted income statement, what we are going to do is we are going to get the cost per unit, which is manufacturing cost per unit. This is the cost of goods sold. You remember the idea? What is the manufacturing cost? It is direct material cost, direct labor cost, and manufacturing overhead cost. So all that information is now in our tables that we did earlier, and this is where it refers to. What it's telling you that for direct materials, there's 2 pounds needed to make 1 unit, and so the unit cost for that, because it's $2 per pound and it's 2 pounds for it's $8. Okay, so $4 per pound multiplied by 2 is going to 8. So same thing for direct labor. It takes 2 hours to make 1 unit. So $10 is the rate for each labor cost. That works for 1 hour, and so it's going to be 20. $8, if you remember your last table, that's exactly what we determined for manufacturing overhead in our last table that you just saw it in this video. And so it's $8, and because it takes 2 labor hours to make a unit, we're gonna multiply 2 by 8, which is the manufacturing overhead rate per direct labor hour, and we'll get 16. So it's $44 for 1 unit manufacturing cost. Okay, that's what it costs to make this unit. In terms of manufacturing, we're not talking about selling, we're not talking about any other head office costs. We're just talking about when we manufacture, what do we have to do to achieve to make this one product. That's it. So it takes $44, and then $15,000 is the total units we're gonna sell during the year, which is something. This is a number we calculated last time. It is one of the previous table about sales budget. If you look at the annual sales, it is $15,000. So $15,000 sales multiplied by its per unit total manufacturing cost is going to give us cost of goods sold, and that's exactly the 660,000 is going to plug in right here under cost of goods sold. 900,000 is going to come from sales budget. This 900 minus 680 gives us 240,000. Then we have selling and admin expenses budget. This is again something that we determine. It's just based on variable costs and fixed costs of selling and administration. Then we get income from operations. Interest expense is $100 because it's given on the top. If you see, it says interest expense is expected to be $100, and then income tax is expected to be $12,000. So we just plug in that $12,000 here, and it flows to. So now we know our profit is going to be $47,900. So look at this. Management has already determined, has already made the future plans, it already has a good approximation of what the future profit is going to be. All the junior managers, everyone has been communicated, and they also agree that this is what the future picture looks like. It's a combined effort based on analysis and logical reasoning. This is what budgeting process, and operating budget is when you get to this to the income statement. That's the culmination of this operating budget process. Okay, so thank you.